Thanks, Rob, for that nice introduction. And, you kind of already summed up what I was going to say, so maybe I don't need to talk at all. But so a few days ago, as we all get hit with ads while we're online, and this ad for a T-shirt popped up, and it immediately caught my attention. And I'm going to tell you what was on it in just a minute. But first, can anyone in here who's a corn grower raise their hand, please? Just you're a farmer and you grow corn. Okay, for the listeners, there's a lot of hands raised right now, and I think that anybody with their hand raised, and perhaps maybe everybody in this room, could agree with the sentiment on this T-shirt, and it was, make the corn price great again. And so that's what I'm going to focus on today. I'm going to talk about what's happening right now that has been making the corn price not so great. What does it take to make it great again? And, what is NCGA doing to help advocate for the interests of corn growers in that process? So in my work, I tend to focus a lot on what's happening on the demand side. And I'm going to get to that. But we wouldn't have a need for demand if it weren't for supply. And all of the corn that we are able to produce. The reality is that farmers are really good at growing corn. Is there anyone here today that's over 85? Okay, well, think of someone you know that is, okay? Think of someone you know that is. What I was going to say is that when we think about someone over 85 would have been born in the 1930s likely, and U.S. corn farmers today actually plant fewer corn acres than what we grew in the 1930s. Think about that for a moment. But in the 1930s, the average corn yield was 24 bushels an acre. This year, USDA is projecting a 183.1 bushel per acre national yield, which would be a record surpassing last year's record. And that's just really phenomenal growth. That's the reason we're looking at another 15 billion bushel corn crop. And this growth in the United States, it has been really amazing, but also global production has nearly doubled in the last 15 years. There's a bunch of FFA members in here. Some of you are probably right around being born maybe near 2007. I'm going to go back to 2007. In that year, the U.S. produced nearly 2/3 of the world's corn production. This year, we're likely going to produce less than 1/3. So when we think about what impacts corn price, of course, studying the U.S. balance sheet is really important. But just in the last 15 years, we've changed from being, less a primarily domestic market or having that large of a share of the world's production to this becoming more of a global marketplace. And certainly what's happening in other parts of the world is impacting our corn price too. And so when we think about our policy and price driving factors, that's really important. And, really the crux of our price problem right now is that global production has been growing faster than global demand. So what is happening on the demand side? The U.S. corn crop is three primary uses. About 35 to 40% of it is used for feed, another 35 to 40% for ethanol, and about 15% for exports. And so I'm going to talk about a few of the challenges we have with exports and ethanol in particular. But first, when we think about exports, after the Phase 1 trade deal was signed in January 2020, we saw record amounts of corn going to China in the next year or two. Then in November 2022, China started importing from Brazil for the first time, importing corn from Brazil for the first time. And that really, changed things for us. Aside from that, during the 22-23 marketing year, we also had this issue where the price of corn at the U.S. Gulf was a lot more expensive than the price at Brazilian ports for most of that marketing year. And we're not just talking about a little bit more expensive. We're talking about sometimes 50 cents to $1 per bushel more expensive. It's just really hard to attract demand in the global market when your product is that much more expensive than a competitor. And what was causing that was partially relative exchange rates. Another reason was the added transportation costs to get down the Mississippi River. If you remember back to fall of 2022, we had low water levels. We had a repeat of that last year. And I've seen some news reports this week that barge traffic has been slowed because the Mississippi River is again very low in some places. And so that's definitely something we need to be keeping an eye on over the next couple months. If that problem persists throughout harvest this year, we could have this problem again where we get this slow start to exports during harvest, which should be our major export opportunity window. The other thing I wanted to note with China is the possibility, and I think this is a real possibility regardless of who is president, for a tariff retaliatory tariff situation with China. And we saw what happened with that in 2018. NCGA has partnered with American Soybean Association and United Soybean Board to do a study digging into what it would look like if there was retaliatory tariffs from China on U.S. corn and soybeans. I've been working with the Economist at ASA, and we're aiming to have that published next week. So that's something to watch for. Also, want to talk about Mexico when we talk about corn exports. Mexico has really been the bright spot for corn exports this year. About 40% of our 23-24 marketing year corn went to Mexico. But here's the problem. The reason they were importing a lot is because their own domestic production was impacted by drought. It's not something we can count on happening every year. So definitely something I'm thinking about for next year. What is the setup for our export situation? The other thing with Mexico is the ongoing dispute over GMO corn. NCGA has been advocating for a positive resolution to that dispute and supporting USTR however we can. So switching to the ethanol front, ethanol has actually been another bright spot for demand this year. The unfortunate thing with ethanol, though, is that there's a ceiling on it because there's a 10% blend wall. And the other challenge on the ethanol front is that the EPA earlier this year released a new rule on tailpipe emissions reductions that essentially sets targets or requirements for what percent of the new vehicle fleet has to be electric vehicles. And of course, if we are hitting those electric vehicle targets, that means less gasoline consumption. And so I used EPA's projected numbers for reductions in gasoline consumption and looked at what that meant for corn demand, and it's not a pretty picture. Just as an example, by 2041, we'd be talking about using 1 billion bushels fewer corn, and that's a number that just continues to grow year after year. And if, NCGA, one of our top priorities has been higher ethanol blends. If we were to get that now, it definitely isn't going to offset the long-term effects of the EPA tailpipe rule, but it could definitely provide a cushion in the short term as we think about potential new uses for corn and or value-added opportunities. And on that front, I just want to note, we are working on the possibility of corn ethanol as a feedstock in sustainable aviation fuel. There's a lot of hurdles to get over, but something that could be a potential use of corn. Another thing to note here is the possibility for value-added opportunities for farmers to get, compensation for growing their corn using sustainable ag practices. These things somewhat hinge on the 45Z tax credit rules. This is a biofuels producer tax credit, something I've been spending a lot of time on this summer. We've been working on how can we advocate for corn growers as part of this. I'm actually going to be at a meeting in D.C. at the U.S. Treasury next week on this topic. And so ultimately, if we want to talk about making corn price great again, developing new and value-added demand sources is going to be really critical because global production and competition continues to grow. In the meantime, the reality is that prices are not so great. The estimated market year average price for this year is 34% below 2022. Meanwhile, the estimated cost to produce this year's crop is only 5% lower than 2022. And using USDA's average cost and average price projections for 2024, that results in an almost 50 cent per bushel loss for growing corn. Definitely a really tough situation to be in. Corn margins can be a leading indicator for operating lines of credit, and I don't think you don't have to know that to figure out that this fall, as we are harvesting this crop and we have fewer returns coming in for a lower valued crop, and more money going out for next year's expenses, that's going to definitely put some pressure on working capital and push higher demand for additional credit. Passing a farm bill continues to also be a top priority for NCGA. We have some of our leadership that will be in DC next week as part of a larger commodity group coalition, really trying to highlight this message of the need for passing another farm bill this year and that certainty that's needed that comes along with that for farmers and all of us in the ag industry. The bottom line of all of this is kind of what Rob said when he introduced me, and that is, ultimately we need a economic policy and tax environment that supports market-based demand opportunities so U.S. corn farmers can continue to produce the most abundant and sustainable corn crop in the world, and that is what it takes to make corn price great again. I'm looking forward to questions or continuing discussion too. Thank you.